So my name's Andrew Keegan. I'm from Blackrock. I head the multi-asset strategies and solutions investment business for Wealth, based here in London. We're here today to talk about future-proofing multi-asset. Well, our investment philosophy is one that we think is really about focus on investment outcomes. It's about achieving, through a disciplined, objective investment process. We look at delivering the best outcomes for our investors by balancing risk, return, and cost, but on a forward-looking basis. We start with the important considerations in life: cost. We think about the risks we face as investors, and we think about how we really embed the best opportunity to deliver return. I think one thing that you will see throughout our investment process is that we have, for many years now, thought about and embedded sustainability into that investment process. When it comes to those considerations, managing risk, I think, is clearly one of our key differentiators as BlackRock, but also as a multi-asset investment team. We think about, low-cost multi-asset investing as an important driver of client flows. We also think about that long-term journey and bringing clients throughout their investment time horizon and to deliver their investment objectives. When we look at what we've seen in the marketplace today, particularly in the low-cost multi-asset index space, generally you've seen a diversified portfolio simply by equity and bond splits. While this concept of a 60-40 has caught the attention of the average investor through its simplicity, we do think that in terms of meeting one's investment objectives over time, having a more active approach to deliver on that asset allocation and that risk management and suitability profile is important. And therefore we differentiate our portfolio approach by adapting the asset allocation, not only the equity and bonds, but also the underlying building blocks, because clearly driving in a rear view mirror is not really going to get you where you want to be. Correlations, an important component of portfolio construction, evolve over time. You cannot just rely on the historic role that fixed income, diversified government bond exposures have had in a multi-asset portfolio. And therefore we think you need to be a little bit more nimble, you need to be a little bit more granular in where you try to diversify, and then think about other assets, particularly in the world we've been in for a number of years, but perhaps what's the role of gold? What's the role of other assets in your portfolio? And of course recognize that the world is changing, and therefore you need to be able to adapt your investment strategy and your building blocks to deliver on that investment objective. I think to talk about some of those key ingredients of portfolio construction with regards risk, we think about diversification between equities and bonds, we think about other assets, but importantly, as we diversify overseas, both on the equity and the bond space, one thing to be mindful of is your currency risk. While over the long run there is no expected reward for that currency risk, it can bring some diversification. But importantly, if you think about from a sterling or UK-based investor, we've seen a material increase in currency risk from a contribution perspective over the last number of years. This is something that you need to be aware of, and I think you do need to be deliberate in terms of the type of currency exposure you have in your portfolio. Some currency exposure from a global equity perspective is important from a diversification. On the bond side, you really want to be hedging that currency risk. Of course, nothing should be static. As currencies evolve, as risks evolve, you should be able to adapt that on a long-term basis. Again, in terms of managing risk from a forward-looking perspective, this is all about helping investors stay invested. So we think about, meeting investment objectives over the long term, but recognize that, in the world we live today, people's goals will have changed. Their lives, their needs will have changed. And therefore we do keep an eye on that more short to medium term risk, not just long-term risk. Again, we believe this helps investors feel confident that there is somebody at the wheel managing their portfolios day in, day out, looking at that trade-off between risk, return, and cost. We talk about cost, clearly one of the certainties of life outside of death and taxes. This is important, particularly as you think about that time horizon. The longer you stay invested, the more you want to put your money to work and not eroded through fees. Again, being mindful of the value of what you get rather than just the price you pay, you do want to make sure that you are getting value for money from your investment. Whether you are, from a DIY perspective, whether you are outsourcing to an investment manager, you really want to make sure you are getting value for money, because the cost impact of that over the long run can erode some of those gains that you will have to set aside for your retirement. making sustainability our standard. When we think about the considerations of risk, we think about the potential for return, there's a lot of myths around sustainability. We've looked at this over many years. We've looked at the decisions we've made through a sustainable lens. What would be the cost from a return and risk perspective? And to be clear, there was none. There was no cost to returns through making all of our investment decisions with a sustainable lens. The benefits we saw was the uplift in terms of sustainability score, but also the resilience that brings to a portfolio. So when we think about sustainability through the environmental, social and governance lens, it is really important to think about the impact that has in my portfolio. The myth that you sacrifice gains to have a more sustainable portfolio is untrue. We've seen this in our view, from historic decisions, but also on a forward-looking basis. We actually think it's moving away from just being a risk, but also a return opportunity. So if we lay out the scenes in terms of what is that opportunity for sustainability, we move away from the historic approach, which was very much about screening out stocks, perhaps those stocks that were deemed to be sin stocks, gambling stocks, to thinking about how I can really optimize between my core exposure, whether it's the FTSE or the S&P, but also try to look at those stocks that will give me that better ESG uplift. Again, so you are optimizing between the core exposure with those companies that have that much more sustainable focus. Moving into something that is a little more targeted in the sustainable approach, which we term SRI, social responsible investing. This is really about targeting those top companies, those companies that come out with the highest ESG scores. Again, there is a role for these in the portfolio as we move from equities into a multi-asset environment where there is now much more greater interest in product development to deliver exposures like green bonds, but also climate bonds that help you round out your multi-asset portfolio with both equity and bond exposures that give you that sustainable exposure. We think this is something that not only will benefit investors today, but for some time to come, as there's a significant shift expected to those companies that are going to be rewarded for being more greener than less. Again, whether it's through the cost of capital or through the flows or the interest, we see significant demand and have seen significant flow into this market. So we believe that it does provide you with not only resilience, as we've seen in periods of heightened volatility in the last few years, those companies that have demonstrated greater sustainability have outperformed. As we think about the future, as we move into this new world, those companies that are greener, as I said, will be rewarded for that much more sustainable approach. When it comes to the impact of climate change on portfolio or on market returns, it is important that we think this transition is favorable for those assets that are more beneficial to sustainability. We divide this into specifically climate change, and we think about capital market returns or expected market returns from companies that have a focus on climate change versus those that don't. And I think explicitly accounting for this in the core of your portfolio construction process, again, is something that we believe is a differentiator, not only to us, but to those that are focused on the long-term returns. As you can see here, the expected return across asset classes, both on equities and bonds, is much more favorable for those sectors, those countries, those companies that are taking action in climate change. And we've seen over the years, those companies that have lagged in this space have underperformed. So again, it is important from a portfolio construction point of view as we look out over the next 5-10 years and recognize that there is great potential return from being more focused on climate change.
Andrew, there's a school of thought that ESG investing means sacrificing gains. Do you think this is the case?
I think it is one of the great myths when it comes to sustainability is that you do sacrifice return potential. I think when we've looked at this historically at all of our asset allocation decisions, if we had made those with a sustainable lens, what would the impact have been? And again, this is testing over many, many years of data. We found that there was no cost to return. There was no impact on risk, but there was a benefit in terms of resilience or greater resilience in the portfolio. Whether it's through metrics such as ratings or just in terms of diversification, we did see that play out. I think actually I would turn it around and say there is a opportunity for greater return, particularly over the next sort of 5 to 10 years from a more sustainable approach. As we see those companies that are greener, more focused on sustainable outcomes, will be rewarded with a lower cost of capital versus those companies that perhaps have stranded assets that are perhaps going to be negatively impacted by government policy, etc.
What will ESG investing look like 10 years from now?
Well, I've worked at BlackRock for a long time. I've never found the crystal ball, but I think it is fair to say that it will become the new normal. As with many buzzwords, it's really important that we avoid greenwashing and things like that. But I do think at its heart, it is about improving outcomes for clients. It is about improving outcome for the world. And it's not just about labels or, options. It's really about, for us, embedding it across our whole value proposition as an investment team. So right from the investment process, philosophy, right down into the investment decisions that we make. We do believe that this is something that's central, core to strategic asset allocation, which is why we've embedded it, in particular a climate-aware approach, into our capital market assumptions. I think there's going to be greater focus on climate-aware now, but over the next couple of years, you will see, again, an interesting focus on topics such as social and governance, where, again, these are clearly opportunities for potential return, but also understanding different risks that we see across companies.
Inflation's at the forefront of many investors' minds. What levers do you have to pull in this space?
Inflation it's a perennial topic. It's also one that's very difficult to time. And it manifests itself in different ways. It's something that is, in the right size or measure, is a good thing for the economy. When it comes to actually trying to mitigate inflation, the negative impact of inflation, this is something that we believe is really important, and no more so than now, because you are seeing an increase in inflation, and there's an expectation that inflation will continue to rise, and will even, from a central bank perspective, they will be comfortable to let inflation run hot for some time. And I think, having the tools available to help you manage risk, a bit like your seatbelt, is important, and something that you should keep at all times rather than try to time. So for us, it's about diversification and fixed income. It's about using inflation-linked bonds. It's about looking at other asset classes that are more sensitive to inflation at different times, such as gold. Again, an asset that we have used in our portfolios for many years, but something that is important. It does react differently at different times, and therefore you do need to keep a more forward-looking or active insight in terms of how you manage for inflation risk.
Following on from that, would you like to talk about the position of the portfolio over the last 12 months?
Sure. Across the range, if we think about the extraordinary 12 months it's been, coming into kind of Q1 of 2020, where we saw this massive spike in volatility, this is where having that kind of active approach to risk management was beneficial, and that we were able to reduce risk across the portfolio. And then as markets kind of rebounded, we were able to add back to risk over time. And again, this meant that we benefited on the downside, but also on the upside. And again, we were doing that by using the building blocks that we have. And this wasn't trading, but this is really, active investing with, index. So something core to our belief. Throughout the rest of the year, again, we looked at, as markets were continuing to go up, we were diversifying our portfolio and not just relying on, the hope that they would continue to go up. So again, allocating to assets like gold, increasing or rotating across our equity positions. As we came into, this year, we were controlling currency risk. I think that's an important part of our portfolio construction process, one that we can do very, very efficiently. And again, it helps us manage that risk. As the concerns around inflation were really picking up, this is where we started to, again, recognize that there is not only an economic opportunity, but we think there's an opportunity for an economic restart. And I think this, is supportive of risk assets, so equity markets in particular, over the short to medium term. And we've actually been adding to equities, so developed market equities in particular. And again, in doing so, we've also been recognizing that we can't just rely on that single asset class. So we've been adding to inflation-linked bonds, again, as an offset potential to diversify our portfolio, but in particular, give us some protection versus nominal bonds when it comes to that increasing inflation that we've seen and that we expect to continue for some time. Mindful of the role that gold plays in our portfolio, we have actually trimmed some of that allocation given its increased correlation with equity. So as we added to equities, we actually trimmed some of that gold exposure.
And delving a little deeper, you've talked about what you're doing at a broad market level. Is there anything you've been doing at a regional or sector level?
That's a really important question. I think, again, something that differentiates the way we build portfolios is that when it comes to investing through index or ETFs, the broad diversification is important, but also recognize when it comes to markets like the US, the returns that we've seen over the last year at least have been dominated by a very small number of stocks We all know them as FANGs, but in particular technology stocks, so a sector play rather than the broad market. So in a sense, it's become quite a riskier play, particularly as we've seen some increased volatility, not only in broad markets, but specifically in that sector. So something that an approach that we take is to not only diversify across using index exposures, but on a regional basis, we're able to diversify across globally through exposures to the US, but also think about blending within the US exposures to core market cap, but also increase sustainability, where we do get a benefit and uplift from technology, but also from things like healthcare. Again, assets that we think have benefited from this COVID pandemic, but actually looking out over the next sort of 5-10 years, these types of sectors and companies will really benefit from this shift to a greater focus on sustainability and healthcare.
How important is cost control when you're thinking about investing?
Well, I mean, I would love if investing was an easy game. It's not, but I do think that controlling costs is one of the few things you can control when it comes to investing. And therefore, when it comes to building portfolios, using low-cost vehicles, when it comes to optimizing your portfolios or rebalancing your portfolio, again, taking cost or modeling that into your portfolio construction is something that we do, and we do believe is an important part of it. And therefore, when it comes to the capital market assumptions, you really want to make sure that you are optimizing and trading off against what is the return potential versus cost, and not just on a nominal sense.
Does the size and scale of BlackRock help you when you're creating multi-asset portfolios?
Well, I think we're very fortunate at BlackRock to have the breadth of iShares when it comes to index and exchange traded funds, something that I myself have benefited over many years. I started building multi-asset portfolios with ETFs 15 years ago, where I could count on my two hands how many ETFs I could access to. We now have clearly a lot more than that. So the breadth of building blocks, the interlinkage with risk management is really important. The fact that we can stress test our portfolios using those exposures and see how they will benefit or diversify, again, is something that's for us a real differentiator, but I think key to modern or forward-looking multi-asset investing.